Hey everyone, welcome back to Corporate Decoder. Today, California C.A.H Account Trust just filed its N-CSR report, and I am seeing a clear story about how these funds operate. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a look under the hood at how several WS money market funds performed and what they invested in. So what exactly is this document? Think of it like an annual checkup for investment funds that are registered with the government. It tells us about their financial health, how they've been managed, and what they've been up to over the past year. This particular filing covers the period ending the 30th of April 2026. The filing dives into a few different WS funds. Let's start with the WS Government and Agency Money Fund. For a hypothetical $10,000 investment, the cost for the last year was just $17. That is only 0.17% of the investment. This tells us these funds are designed to be very low cost for investors, which is typical for money market funds. Looking at the key stats for this fund, the net assets were over $5.5 billion. That is a massive amount of money. The fund held 95 different investments, and importantly, its weighted average maturity was only 30 days. This short maturity is a key feature of money market funds, meaning they invest in very short-term debt. It helps them keep the value of the shares very stable, aiming for that $1 price per S.C.I.XX. When we look at where the money was invested, it was split between government and agency obligations at 53% and repurchase agreements at 46%. Repurchase agreements or repos are basically short-term loans where one party sells a security and agrees to buy it back later at a slightly higher price. It's a common way for money market funds to earn a small return safely. Next up is the DWS Government Cash Institutional Shares. This fund also had massive net assets, exactly the same at over $5.5 billion, and 95 holdings with a 30-day weighted average maturity. The costs here were even lower, just $15 for a $10,000 investment or 0.15%. This highlights how efficiently these large funds can operate. The 7-day current yield was 3.56%, showing that even with low costs, these funds were offering a decent return. Now let's switch gears to the DWS Tax-Exempt Portfolio. This section covers funds where the interest earned is generally not taxed by the federal government, which is a big deal for some investors. The WS Tax-Exempt Cash Premier shares had net assets of about $106 million. While smaller than the government funds, this is still a significant amount. The weighted average maturity here was very short, just 6 days. This is even shorter than the government funds, aiming for maximum stability. The cost for a $10,000 investment was $20, or 0.20%. The 7-day current yield was 3.21%. The asset allocation here was quite different. It was heavily weighted towards variable rate demand notes at 94%, with only 5% in tax-exempt commercial paper. Variable rate demand notes are a type of short-term note where the interest rate can change, offering flexibility. This filing also includes important details about fees paid to the independent auditors, Ernst & Young. For the DWS Government and Agency Securities Portfolio, the audit fees for the year ended the 30th of April 2026 were $28,722. Tax fees were also billed around $5,969. These are the fees paid directly by the fund. Then there are fees billed to the fund's advisor, WS Investment Management Americas. For tax fees, they were quite substantial, over $500,000 in 2026 and over $1 million in 2025. This suggests complex tax compliance and advisory work related to the fund, often done at the advisor level rather than directly by the fund itself. The total non-audit fees billed directly to the fund were quite small, just $5,969 in 2026, mainly related to tax services. But when looking at non-audit fees billed to the advisor that relate directly to the fund's operations, that number was much higher, over $588,000 in 2026. This indicates significant work being done for the fund's overall operational and financial reporting by the advisor's accounting firm. Now for the meat of the financial detail, the investment portfolio. This is where we see exactly what these funds are holding. For the DWS Government and Agency Securities Portfolio, as of the 30th of April 2026, the fund held over $1.3 billion in US Treasury bills alone. You can see a long list of individual Treasury bills with various interest rates and maturity dates. For example, there is a Treasury bill maturing in February 2027 with a rate of 3.45% valued at nearly $30 million. A huge chunk, 46.2%, was in repurchase agreements. This table shows millions and millions dedicated to these short-term lending operations, with various banks like Banco Santander, Barclays, and JP Morgan Chase. For example, T.R.U.S.T repurchase agreement with Banco Santander for $475 million. The total cost of government and agency obligations was over $2.9 billion. This is the core of these funds, ensuring safety and liquidity. Looking at the statement of assets and liabilities, the fund's total assets were over $5.6 billion. Liabilities were much smaller, around $12.8 million. This healthy gap between assets and liabilities shows strong financial footing. The net assets of the fund were a massive $5.59 billion. This is the total value attributed to shareholders after all liabilities are paid. Crucially, for all the different share classes we looked at, DWS Government and Agency Money Fund, DWS Government Cash Institutional Shares, Government Cash Managed Shares, and Service Shares, the net asset value, or NAV, was exactly $1 per S-share. This is the primary goal of a money market fund, to maintain that stable dollar value. The statement of operations shows the fund's income and expenses. For the year ended the 30th of April 2026, interest income was over $221 million. Expenses, including management fees and administration fees, totaled around $10.9 million before reductions. However, they had expense reductions of around $2 million, bringing the total expenses down to roughly $8.9 million. This often comes from the fund manager waiving some fees to keep overall costs low for investors. The net investment income was over $212 million. This is the profit the fund made from its investments that can be distributed to shareholders. The statements of changes in net assets show how the fund's value grew or shrank. Net assets increased by over $890 million in 2026. This big jump comes from the huge amount of money flowing into the fund. People buying shares, which was over $98 billion in proceeds from shares sold and reinvestment of distributions. Then we get to the financial highlights. For the DWS Government and Agency Money Fund, the net asset value per S-share remained steady at $1 throughout the years shown. The total annual return for 2026 was 3.96%. This is a key number for investors, showing the overall gain from the investment. The footnote mentions that total return would have been lower if certain expenses hadn't been reduced, which again points to fee waivers helping boost investor returns. The ratio of expenses after reductions was very low at 0.17%. This confirms the efficiency of these low-cost funds. For the DWS Government Cash Institutional Shares, the total return was slightly higher at 3.98% in 2026. Even with slightly different expense ratios, the overall performance was very similar. The notes to financial statements are where you find the really detailed explanations. The fund itself is organized as a Massachusetts business trust and is registered under the Investment Company Act of 1940. It is managed by DWS Investment Management Americas, or DIMA. A really important part here is security valuation. These funds use the amortized cost method, which is allowed for money market funds. This method values securities at their cost and assumes a constant rate of earning interest until maturity. It is a way to minimize fluctuations in the share price, keeping it around $1. The filing states these securities are considered level 2 in terms of valuation inputs because they aren't quoted prices in active markets, but rather observable inputs like interest rates. We also learn about the repurchase agreements. The fund holds billions in these, with collateral exceeding the value of the agreements. This collateral provides a safety cushion. This section details the management agreement with DIMA. The fees are structured in tiers, with lower percentages applied to larger amounts of assets. For the fund, the management fee rate was effectively about 0.067%, and DIMA even contractually agreed to limit it further to 0.05%. This shows a commitment to keeping fees down. There are also voluntary waivers of fees and reimbursements of expenses by the advisor. In 2026, these amounted to over $2 million across various share classes. This is a significant benefit to shareholders, directly boosting the fund's yield. The statement of operations for the DWS Government and Agency Securities portfolio shows that interest income was a huge $221 million for the year. After all expenses, and importantly after those expense reductions and waivers, the net investment income was over $212 million. Looking at the financial highlights again, a key figure is the net assets end of period. For the DWS Government and Agency Money Fund, it was $380 million or $3.38 billion, an increase from the prior year. The ratio of expenses after reductions remained very low, at just 0.17% for the money fund and 0.15% for the institutional shares. This is incredibly efficient management. Finally, the report from Ernst & Young. They've audited these funds for a very long time, since at least 1979. Their opinion is that the financial statements fairly present the financial position of the funds in conformity with generally accepted accounting principles. This is the standard auditor's sign-off, confirming the financials are reliable. This section is all about how the Board of Trustees reviews and approves the investment advisory contract. They considered many factors, including past performance, fees, expenses, economies of scale, and other benefits to the advisor. For the DWS Government and Agency Securities portfolio, the board noted that the contractual fee rates were lower than the median of comparable funds, and the total operating expenses were also competitive. They specifically mentioned expense limitations and voluntary fee waivers by DEMA as important factors in keeping costs down for shareholders. Switching to the tax-exempt portfolio section, this is where we see the financials for funds focused on tax-free income. The investment portfolio here is heavily focused on municipal investments, making up 99.2% of the holdings. We see various state and local government obligations like bonds from California, Florida, and Illinois. For instance, there is a California Bay Area Toll Authority revenue bond, paying 3% interest valued at $1.8 million. The total cost of these municipal investments was about $105.6 million. The DWS Tax-Exempt Portfolio had net assets of about $106.5 million. Again, assets vastly outweighed liabilities, indicating a solid financial position for this fund. And just like the government funds for all the tax-exempt share classes, the net asset value per S.C.I.XX was also $1. This stability is paramount for money market funds. Interest income here was around $3.1 million. Total expenses after reductions were about $351,000, a much smaller expense ratio compared to the assets held. The net investment income was over $2.7 million. The financial highlights for the tax-exempt funds also show a consistent $1 net asset value per S.C.I.XX. The total return for DWS tax-exempt cash premier shares was 2.34% in 2026. The expense ratio after reductions was 0.20% for this share class. In the notes, we see that the DWS tax-exempt portfolio had a liquidity fee potentially imposed on redemptions. This is a mechanism to protect remaining shareholders if there is a rush to sell by allowing the fund to charge a fee to those exiting. For the service shares, which were liquidated in November 2025, there is a specific note about that. Just like with the government funds, the board reviewed the advisory agreement for the tax-exempt funds. They noted that the management fees were comparable to the median of similar funds, and the total operating expenses for most share classes were higher than the median, but this was contrasted with the advisor's voluntary fee waivers. This indicates a continuous effort to balance service costs with shareholder value. Ernst & Young also audited the tax-exempt portfolio, issuing a clean opinion, stating the financial statements are fairly presented. Overall, this filing paints a picture of well-managed, low-cost money market funds. The DWS Government and Agency Securities portfolio is a giant fund focused on short term US government debt and repurchase agreements aiming for stability and liquidity. The DWS tax-exempt portfolio is smaller but follows the same principles, investing in municipal bonds with a very short maturity and providing tax-advantaged income. The recurring theme is the commitment to maintaining a $1 share price through careful management of short-term high-quality assets and the advisor's willingness to waive fees to enhance investor returns. The key risk for these types of funds, as highlighted in the report, is always interest rate changes. A sharp rise in rates can decrease yields and potentially impact the stability of that $1 NAV, while falling rates can make yields very low or even negative. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take, Stay Decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.